Now, what I want to talk about real quickly, Charles, is the power of cash flow stacking. And we only alluded to this in the 100% Debt-Free for Life class. So if we were to expound on that slightly by bringing in an additional case study to this presentation, you're going to see the magic of the compounding impact of multiple properties playing a role in this. So ultimately, when we talk about getting out of debt, we explain in that first class that you can flip these amortization schedules upside down and truly avoid the vast majority of the interest that you would otherwise pay, regardless of how great or poor your starting interest rate is over the term of your fixed mortgage, whether it's a 15-year, a 30-year, makes no difference. And Charles, you've seen this class now
for years, yeah.
Years and years. What is your impression of utilizing these techniques inside a real estate investment portfolio?
Okay, so let me start by saying you don't have to utilize these techniques. Everything that I've just talked about should come true over the long term, and you should be able to pay off your property 13, 15, 17 years, something like that. That's what people like me have done for years and years and years. What Matt talks about accelerates things so fast, it's almost unbelievable. And having worked a radio show with Matt in the past and having been to dozens and dozens of classes that we co-teach together, I usually tell people at the end of the class, I know you're blown away. I know you don't believe this. What you need to do is sit down with Matt. He will show you every single number. The math actually works. There is no speculation. The short answer is, if you use the cash flow stacking techniques, you will pay off these properties much, much faster. It is just a mathematical certainty.
Absolutely. And the reason it works so well is because you're essentially taking debt weapons and you're utilizing those debt weapons for purposes of income producing asset acquisition. And then you begin to paycheck or rent check park that extra cash flow. And that process is cyclical. So it just continues over and over again. So what I'd like to do is reference another case study. I'm going to bring Josh Hansen into this equation because I think he can explain it best and show you the power of how this exponentially will build on itself, where the momentum increases so quickly that you can begin to own properties free and clear in a matter of a couple short years versus 10, 15, 20, or 30. So let's go ahead and introduce Josh Hansen into this story, and then we're going to go into exactly what debt weapons are in order to remind you about that, because those are the key tools in order to allow cash flow stacking to play a role. So Josh and I met about 2 years ago exactly, and Josh had attended one of our live classes, came back to another live class with his business partner, and at the time had already dipped his feet in the water, so to speak, with real estate, had a couple cash flowing properties, but really wanted to take it to the next level. And we were teaching a class about that very subject, not a whole lot different than what we're teaching here today. And during that, we exposed him to the concepts of cash flow stacking, and he really took it to places that very few have, and has kind of become the poster child of these techniques. I want to go through the details with him, but I want him to kind of share what his first impression of the information was when he first saw how to use lump sum payments, how to use debt weapons, how to use cash flow stacking, and how it related to acquiring a portfolio of real estate. So Josh, how are you doing today? And thanks for being here.
I'm great, Matt. I appreciate you having me on.
So what exactly did you think of the information when you and Scott first attended the classes?
You know, that's a great question. When I first saw this concept, I was very skeptical in nature. By trade, I'm a CPA, and so I am a numbers guy, so to speak, and look at everything very analytical. I can tell you when I first took the class, I was asking myself the question, why didn't I hear about this before? You never really heard the concept. You never hear other investors talking about this. And so my initial impression on this was a very high level of skepticism, but after sitting on it for a couple of weeks, I decided, well, maybe it's really worth my time to sit down with these guys and understand what this concept's all about. And at the end of the day, it really aligned with my goal. And my goal from the very beginning is to build wealth. And how to do that was through the vehicle of cash flow real estate.
Okay. So when we first met, how many properties did you have? Do you remember?
When we first met, at that time I was at, I think, 4 properties that were decent cash flow plays, but nothing spectacular.
And so we're now at 2 years later, and how many properties in total do you have with and without Scott?
Well, I guess just to kind of clarify, so Scott is my partner, so I can't say that I own this, real estate 100%. I wish I did, but having Scott has been fun and exciting for us. But with Scott and myself, I'm up to 22 properties today.
Okay, that's phenomenal. And obviously, not everybody listening right now it has that same goal. Maybe they want to own one, maybe they want to own twice that many. That's fine. The concepts apply either way, right? You and I were talking before the class today about the misconception of either increasing your assets and your wealth or eliminating your debt, but not being able to do both simultaneously, right?
Yeah, that's correct, yeah.
And you've been able to successfully prove that both can be done. In fact, the way that you've acquired income producing assets has allowed you to accelerate the elimination of your debts and use the cash flow stacking technique. So let's go ahead and start demonstrating that now. We've got Josh's cash flow cruncher here, and this is going to look familiar to you from the 100% Debt Free for Life class, okay? So you've got your cash flow summary page, revenue and assets, the debts page, living expenses, business expenses, action steps, and the loan calculator. Now, this is just a snapshot of the real estate section of the cash flow cruncher. So I don't want you to pay attention to anything other than the revenue and assets and the debts. What we're going to do is go through a chronological history of Josh's activity buying real estate and what that's meant from a cash flow perspective, and then how cash flow stacking actually works in a 202 format where you can accelerate the elimination of each one of these mortgage balances almost more quickly than is believable, right? Now, you had come running up to me a short time ago at a real estate investor success summit, which is one of the largest conventions here in the Denver area. And if you don't know Josh, he's about 7'6". So it's very easy to see him in a crowd. There were probably 400 or 500 people there. And he noticed me, I noticed him, and we kind of met in the hallway. And what did you say to me at that time?
Well, just for clarification, I'm only 6'7". I'm not the Yao Mings out there, but nonetheless, I do tower over a lot of individuals out there. But I ran up to Matt, and I was so excited because I hadn't seen him for just a little over a year. And I went up to Matt and said, Matt, you won't believe this. Paid off my very first property in 20 months, debt-free.
Debt-free, mortgage-free on a property in 20 months. So if that piques your interest, here's how it was done. Right now, let me ask you this before we dive right in. Do you happen to recall the total amount of interest that you paid on that one property?
I think I could pin it down to $5,876.23.
So yeah, you can see Josh is a CPA, obviously. He cares about the numbers.
So just over $5,800.
Okay, and is that property here on this list?
It is. It's the very first property, 100 Circle.
So it was the first property that you bought. And we do have a specific format for which properties we would target first, and there are a number of different factors that need to be considered. So don't try and run with this as your specific circumstances, because you may not pay off the first property that you acquired versus other properties. So there are certain things you need to think about when it comes to that. But it just so happens that the first property that Josh acquired was 100th Circle. What was the mortgage payment on this when you first acquired it?
The mortgage payment, I'm going to refer to PITI, principal, interest, taxes, insurance, all in was just around $600.
Okay. Now, what was the total rental income, which I'm going to put on the revenue and assets page? And by the way, keep in mind that if you haven't had your personal implementation coaching session yet, after watching the 100% Debt Free for Life class, that is a free consultation. We show you some of this, and you will also get your own free copy of this cash flow cruncher. So if you don't have this yet, make sure you watch that class again, fill out the feedback form, get your free session, and we'll email you a copy of this spreadsheet. So on the revenue and assets page, we're going to go ahead and put the rental income that will offset the expense of 100 Circle. So what was the revenue that was being generated on this property every month?
$1,400.
Now, when you insert the $1,400 revenue, you can see on the cash flow summary page, the mortgage is listed of $600, PITI, and the revenue and assets of $1,400 was also listed, whereas you can see the net cash flow is now $800, right? Now, if we were to use cash flow stacking with just one property, Josh, we have a specific formula where we would take a specific lump sum amount from a debt weapon and apply it towards that mortgage that is all determined based on the amount of cash flow. Now, in this case, that number would be approximately $10,000, whereas we know we could do that about once a year. So in this case, if we were to take that mortgage balance of $93,000, let's call it 4.5%, which puts us at $471 principal and interest. Then we have the taxes and insurance on top of that. So that would put us right at about 600, right? Okay. So in month one, if we were to follow this specific cash flow stacking formula on this loan calculator page, we could, from a debt weapon, borrow $10,000 and apply it towards this first mortgage. And by doing so, we could prevent $23,900 worth of interest. Now, over the course of 1 year, you will have interest payments on this $10,000, but it will be significantly less than the $23,000 that you just saved. And in 1 year's time, down here on month 12, you could do the same thing again. So you can see now you've saved $39,000 plus in interest. And that process is washed, rinsed, and repeated. That is cash flow stacking with just one income producing real estate property. But Josh and his partner did not want to stop after one. So I just want to show you the power of how this was accelerated and demonstrate how it's possible to pay these properties off in, what did you say? You paid this one off in
20 months.
20 months. Okay. Now, this property was purchased right around the same time that we met you. Okay. A couple months after that, you went on a buying spree, right? You purchased several properties in a row. So which of these properties did you buy after 100th Circle?
We bought Biscay Street, Carson Way, Humboldt, 55th Avenue, and the very last one at the bottom, Tennessee Avenue.
Okay.
All in the following spring.
And why is Tennessee at the bottom here?
The reason we have it at the bottom there is because there's 4 units within it. It's a fourplex, so I count those as 4 units. They're each separate properties or units in my mind. And
okay.
It's easier to track that way.
So you bought these 5 properties, Biscay to 55th and Tennessee. What was the timeline that it took you to buy those?
3 months.
Okay, so let's go through those one at a time and include the mortgage payments, and we'll go back to the revenue and assets page and put in the income that you generate from each one. Okay, so what is the principal, interest, taxes, and insurance payment? And by the way, just so you guys know, it doesn't hurt to take your taxes and insurance and put that on the living expenses page because it is an expense that will continue even after the debt is paid off. But for purposes of this example, let's include the full amount in order to make sure that the cash flow is accurate. Does that sound good?
Yes.
Okay, so what is the monthly principal, interest, taxes, and insurance payment on Biscay?
$600.
And how about Carson?
$565.
Humboldt?
$545.
55th?
$575.
And then Tennessee is a fourplex. What is the monthly payment on that?
$1,660.
Okay. So you can see, going back to the cash flow summary, now we have a lot more in the way of expenses. So the mortgage payments have brought the outgoing to $45.45, and the revenue and assets is currently only on the 100th circle of $1,400. So now this would be negative cash flow if those properties were vacant, which they're not. Obviously, they're rented. So let's go to the revenue page and offset those expenses with the income. So what is the revenue on Biscay?
$1,340.
And how about Carson?
$1,215.
Make sure everybody can see that. And Humboldt?
$1,285.
55th?
$1,235.
Wow. Okay, and Tennessee is the big one, right?
Yes.
What are you getting on that one?
$4,800.
$4,800. So you're renting those on average for $1,200 a piece.
Correct.
Wow. Okay, this is going to be amazing. So now you can see the total income has increased to $11,275, right? And I think I see where this is heading. On the summary page now, you're netting cash flow of $6,730
Per month.
per month. Okay, that's phenomenal. And you did this from the first property on 100th through the final property on Tennessee in what time window, approximately?
6 to 7 months.
Okay, so in 6 to 7 months, you were able to increase your monthly positive cash flow to $6,730 every single month without factoring in what you were earning on your day job of you and your wife both being a CPA.
That's right.
Wow. Great. Okay, so when you properly use cash flow stacking, this new $6,730 amount can be applied in the form of a lump sum payment. So in theory, I know that if I take $6,730 and multiply that times 12, and I borrow that amount from a debt weapon, and then I paycheck park against that debt weapon, in theory, that dollar amount is paid back in approximately 1 year's time.
That's right.
Before interest.
That's right.
Okay.
Interest.
And the interest amount is so small that it generally is paid back in a year's time or faster. Okay. So let's do those numbers quickly. How long would it take to pay off $93,000 on a loan amount with a positive cash flow position of $6,700? If we took $93,000 and divided it by $6,700 in positive cash flow, you'd be able to pay that property off in about 14 months. Now, the reason you didn't is because you were acquiring those properties over the course of a 6-month period, right?
Right. Between that and some repairs and maintenance. But this is exactly the model that we implemented. And that's what's so key here is exactly what you're walking down is what we did. Now, we didn't make it the payments every single month.
Of course.
It'd be every 3 months.
Of course, which is the lump sum payments and the paycheck parking element. We don't even call it paycheck parking at this level. We call it rent check parking. There are a lot of different techniques to make this work properly and in your favor. There are a number of ways to do this and do it to benefit yourself versus what the bank is asking you to do. So there's not necessarily a right way or a wrong way, as long as we agree that the one and only wrong way is the way that the bank is asking. Because the fact is the bank isn't in business to make you money. The bank is in business to make themselves money, and that's perfectly okay. But this is teaching you a way to benefit both you and the bank. So let's go back to the debts page and go through the rest of these so you can see how things are looking currently for Josh. So what is the current monthly mortgage payment, principal, interest, taxes, and insurance on Avenue?
$660.
And 55th?
$480.
Okay, and Harvard?
$580.
Alrighty, and how about Deep Haven?
$600.
All right, and Genoa?
$580.
Biscay?
$590.
And Hooker?
$600.
Okay, so let's go to the revenue and see what the offsetting numbers on those currently are. What's Avenue?
$1890.
So you're renting it for $1890. That is phenomenal. 55th?
$1,200.
Harvard?
$1,175.
Deep Haven?
$1,265.
Genoa?
$1,175.
Biscay?
$1,350.
And Hooker?
$1,400.
Look at this. Total revenue, $20,730, which means that the cash flow currently is approximately $12,095 positive on average each month, notwithstanding vacancies and unexpected repairs, etc. But I think you have a pretty good chance of covering those things when they come up here and there.
We have a pretty good foundation today.
I would say so. Now, this is why you get into real estate, okay? If you were wondering before, I'm guessing you see it now. Josh is one of the enormous success stories that are out there. And again, you don't have to necessarily set your sights on the same goals that he has. Your goals are going to be different, and that's okay. It might be more, it might be less. The concepts apply at any level, which is why we wanted to show you that it works even with one property. And you'd be doing these techniques even if you only had one in your portfolio, right?
Well, that's a great point, Matt. My underlying goal is quite simple: build wealth. And you said it best: is we want to increase our asset base and pay off debt. A lot of these properties may not appreciate, given the environment we've been in the last 3 years. Today, we're using it to pay off debt and acquire more properties.
Now, one quick thing I want to point out that's really meaningful here is that 100th Circle you ended up paying off, right? Correct. So you paid this one off in 20 months with a total of $5,800 and whatever the rest of that number was that you gave in interest, right?
Yes.
Okay, and once that was paid off, you did something very special.
We got another debt weapon on this property in the total of $95,000.
Okay, so this one was paid off to zero, and then you went back and acquired a debt weapon where you could access $95,000 if and when needed, which you then would use to acquire more income-producing real estate.
That's right.
What an unbelievable cycle. I want to point out one other thing. Josh is a highly knowledgeable individual as it comes to both accounting and bookkeeping. So Josh and I are putting together a really exciting class where you can learn everything you need to know about keeping your books in order, which is another form of proper utilization of debt weapons. When you properly use debt weapons, you'll see here shortly that the number one benefit is maximization of cash flow. And keeping your books in order allows you to do that. So even if you're in coaching, this is a very important piece to your puzzle, which is why we're going to bring you that class. Keep your eyes open for it. And with that being said, I really appreciate you being here and sharing your story. Thanks a lot, Josh.
Thanks for having me.